Hello again, and welcome to another episode of the Ask the Doc Life Lessons podcast. I'm Dr. V, and today we're going to dive into a topic that plays a critical role in building long-term wealth: investment funds. Whether you're just starting your investment journey or looking to refine your portfolio, understanding investment funds can help you make informed financial decisions. In this episode, we'll define what investment funds are, explore the 8 main types of investment funds, discuss their performance, and provide some resources to help you choose the right one for your specific goals. So let's jump right into this. First, what is an investment fund? At their core, investment funds are pools of money collected from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, real estate, or even commodities. These funds are managed by professional fund managers who make investment decisions based upon the fund's objectives. Investment funds offer several advantages, including diversification, professional management, and accessibility to a wide range of assets that might be difficult for an individual investor to buy on their own. It's really that simple. Now, let's explore the 8 main types of investment funds, because as you attempt to diversify, you may want to choose 1 or 2 or 3 of these types of funds. So here they are, the 8 types of investment funds. Number 1, mutual funds. These funds pool money from investors to buy a diversified portfolio of stocks, bonds, or other securities. They can be actively or passively managed. Number 2, we talked about this in the last episode, exchange-traded funds, ETFs, similar to mutual funds, but traded on a stock exchange, like individual stocks, but they offer low fees and very high liquidity. Number 3, index funds, a type of mutual fund or ETF that aims to replicate the performance of a market index such as the S&P 500. They have low costs and are great for passive investors. Number 4, hedge funds. These are very high-risk funds available to accredited investors only that use complex strategies like short selling, leverage, and derivatives to maximize returns. Be really careful with this one. Money market funds. These invest in short-term, low-risk securities like government bonds or treasury bills. They provide stability and even liquidity. Number 6, bond funds. I'm not big on bonds, but you know what? Other people are when the economy goes south. They focus on fixed income securities like government and corporate bonds, and they offer lower risk compared to stock-based funds. Number 7, real estate investment trusts or REITs. These funds invest in income-generating real estate properties, providing exposure to the real estate market without direct ownership. And then number 8, target date funds. Designed for retirement planning, these funds automatically adjust their asset allocation over time to reduce your risk as the investor approaches their retirement. Each of these funds serve as a unique purpose depending upon the investor's goals, risk tolerance, and time horizon. Do you need it now or do you need it 30 years from now? That's the question. Let's take a quick look at how these funds typically perform over time. And remember, there's no guarantee of performance, and you need to check with a licensed broker before investing. Stock-based funds, like mutual funds, have historically delivered strong long-term returns, averaging between 7 and 10% annually, but come with higher volatility. Hedge funds can provide high returns, but often underperform the market benchmarks due to the high fees and complex strategies. Money market funds are very low risk, but they only provide a return of between 2 and 4%, making them only ideal for capital preservation. Bond funds typically yield 3 to 6%, but offer stability, but also lower growth compared to stock funds. REITs, real estate investment trusts, have historically provided 8 to 12% returns, benefiting from real estate appreciation and rental income. And target date funds that adjust their risk exposure over time average typically between 5 and 8% return, making them a solid option for retirement planning. While past performance does not guarantee future results, understanding historical trends can help you align your investments with your financial goals. And as always, as I mentioned a minute ago, you need to get counsel from a CPA or a licensed stockbroker before investing. These are merely suggestions and my personal advice. Let's check out some resources for you. If you want to explore investment funds a little bit more in detail, here are some valuable things to think about. Morningstar.com offers in-depth analysis of mutual funds, ETFs, REITs, and other investments. Investopedia.com, a great resource for learning investment terminology and overall strategies. I use both of those quite a lot. The SEC's investor.gov provides essential guidelines on selecting funds and understanding investment risks. And of course, financial advisors, consulting with them can help tailor your investments to your specific goals and needs. Taking the time to research and educate yourself could make a huge difference in your investment success. Now, to wrap this up, investment funds offer a diverse range of options for investors at all levels, novice, intermediate, and sophisticated investors. Whether you're seeking long-term growth, income stability, or a balance of both, there's a fund that aligns with your financial goals. Some people use these funds just because they don't want to spend the time to research individual stocks. Now, what's the key takeaway here? The key takeaway is understanding that these types of funds, right, know what they are, evaluate their performance, and choose wisely based upon your overall risk tolerance and investment horizon. Are you 22 years old, 35 years old, or 50 years old? That's what I mean by time horizon. So that's it for today. If you found this episode valuable, please don't forget to subscribe and share it with others looking to enhance their financial knowledge. Thanks for listening. Until next time, always remember to invest wisely. This is Dr. V signing off.